Good afternoon and welcome to this Yellowstone Advisory webinar with Rotork plc. We're delighted to have with us the new CEO, Kiet Huynh, and Director of Investor Relations, Andrew Carter, with us today. I'm now going to hand over to Kiet to take us through the presentation.
Good afternoon, everyone. Thank you for joining us. It's a pleasure to be presenting to you today. My name is Kiet Huynh. I'm the CEO of Rotork. So just to introduce myself, my name is Kiet Huynh. You'll see the name spelled as K-I-E-T, but it's pronounced Kiet, as in the last bullet point there. I'm originally from Vietnam, that's where the name came from, but I live in the UK now. I've been with Rotork for over 4 years now, joined in 2018 as Managing Director responsible for our Instruments division. And then Rotork went through a reorganization and divisional realignment in 2019, and we changed from 4 product divisions into 3 end market divisions. And I led 2 of those 3 divisions, the Chemical Process and Industrial division, and also the Water and Power division, before being appointed as CEO in January of this year. I'm a mechanical engineer by trade. I've spent my whole career within the flow control industry, and I've worked for companies such as IMI and Trelleborg in the past. I'll hand over to Andrew to introduce himself.
Hi, thanks, Kiet. I'm Andrew Carter. I'm the Group's IR Director. I have been a sell-side analyst for most of my career before joining Rotork 3.5 years ago. So I focused on UK industrials. So I've known, well, I should say pan-European industrials, but I've known Rotork for quite some time. I wrote my first note on the company, I think, in 1997. Seems like a very long time ago now. But should we jump forward a slide, Alex?
So just wanted to start, or should we do?
Yeah, just if we just go back one, just to talk a little bit about the purpose, I guess.
Yeah. So we wanted to start the presentation just by introducing Rotork's purpose, which is keeping the world flowing for future generations. We are a purpose-driven organization, and work for us means more than just simply products and services. So our purpose is also built on strong foundations, and these are our values, which are stronger together, always innovating, and trusted partner. I guess with that, I'll hand over to Andrew, seeing as although I've been with the company longer than Andrew, his association with Rotork has been far longer than mine. So I'll let Andrew give you an overview of the company history.
Yeah, jumping on one then, Alex. Yeah, that's brilliant. Thank you. I won't read through everything on here, but I guess the key messages really to take from this slide is first of all the 1957 on there. I think is quite important because Rotork as a business was formed right at the dawn of automation. In 1950s, that's when industrial automation started to accelerate in a very big way. Pre the formation and the foundation of Rotork and the design of its products, valves in industry were operated by hand, hence the picture on the left. So whether they would be in a remote location or whether they could be in a very hazardous location, they were operated by hand. And with that obviously comes not just cost and inconvenience and stuff, but also the ever-present risk of human error. So Rotork is very much an automation company. Rotork invented the electric actuator, and that's still very much core of the product portfolio that we have today. I think the other key message I would take from this slide is really the international nature of the business. The founders and the original senior management of Rotork were very aware of the importance of moving out of the UK, and the expansion into some of the countries mentioned on there, such as France and Italy, actually happened at a very early stage in the company's history, and the company remains very, very international today. We are truly a global business with operations everywhere that you can imagine. I'll leave it there on history. Alex, if you wanted to just jump on to the next slide, This is just to give a little bit of an idea as to the products and services that Rotork designs, manufactures, and obviously provides to the customers. There's a whole bunch of products pictured there. I think the key things to be mentioning here is to talk a little bit about end markets. So our products are really used anywhere where there is a fluid. The history of Rotork, perhaps the origins of the business, tend to be more on the oil and gas side, but over the years the applications have expanded considerably, and we are a very big player in things like water and wastewater, power, chemical, general industrial, etc., etc. And the key to the different products that you see on the slide is really its automation, as I mentioned on the previous slide, and its control. And those are the things, those are the trends that our customers are looking for when they select Rotork products. It's about operational efficiency, and it's about improving the environmental or reducing the environmental impact of facilities. The products that you see on there, one of the things that you won't immediately be aware of just from looking at the little pictures there is some of the environments that we play in, and we'll talk about this again on another slide, but we're very much talking about products that are able to be used in extreme environments. We're looking for products that in many cases are required to be triply redundant, therefore something can go wrong, but there's a second safety network behind it or backup behind it, and maybe a third. We're also talking about products that increasingly have battery backup for similar reasons. And we're talking about products that have actually got internal intelligence so that data can be taken from them and can be used by the customers. I'll leave it there on that slide. Do you want to jump forward one, Alex? This is just tries to sort of split the product suite that we saw the pictures of on the previous slide into sort of 4 buckets. And again, there's quite a lot of information on here, which I won't go through in an enormous amount of detail. But the key products ranges within Rotork, there are 4, as you can see. So electric actuators, fluid power or pneumatic and hydraulic actuators, gearboxes, and instrumentation. The core and the origin of Rotork is very much about electric actuators. And I think the key thing to take from the little box there is to point out that, you know, we're seen very much as being the leader in the market. Very difficult for us to really estimate our market share very precisely because many of the competitors are in bigger businesses, but we think it's somewhere in the region of around a 20% share. It's a relatively concentrated industry. There are not that many people that can make electric actuators of the type that Rotork does. The pneumatic and the hydraulic piece is a bit more well, it's a less concentrated industry. There is more competition in this area. Pneumatic and hydraulic actuators are similar to electric, but as the name suggests, the power to open or close the valve is either pneumatic or hydraulic, hence fluid power. Whereas with the electric actuator, the motive power to open or close the valve is electric. Perhaps just to say, one that we sometimes get some questions on, people ask us a little bit about instrumentation. What exactly is that? And it's important to understand it's very closely related to the actuator businesses that we've just mentioned, as similarly as the gearbox business. So the kind of product suite that we have within instrumentation, it includes things like precision valves that are actually used in actuation itself. Things like positioners and controllers, which again could be used in actuators, and things like position indicators. So our instrumentation business is in some cases selling to our own businesses, and in some cases selling to external third-party actuator manufacturers as well. If we just jump onto the next slide, Alex, I think this talks a little bit about the world in which our products operate. And again, I won't go through every bullet on here, but the message I'm trying to really give here is that the applications that our products and our services are working in, they're very demanding. You know, our customers are relying on our products to keep their operations working. They're critical products. Cost of failure is very, very high. In some of these plants, you could be talking about tens, if not hundreds of thousands of dollars for every hour of downtime. So it's absolutely imperative that our product is very reliable. We're talking about really tough environments as well. So I mentioned that it could be remote, it could be in a sort of a hazardous area where there could possibly be hydrocarbons in the atmosphere. We could be talking extreme temperatures, etc. So whilst those products that we showed the pictures of, they might look relatively straightforward, our customers could be saying to us, we need this product to be certified to be able to operate at -50 degrees or equally at +50 degrees. And our products have to be able to do that and satisfy certification that they're able to do so. Specification levels are high as well. The bullet point there saying certification, we are often finding that our product needs to satisfy industry-specific certification requirements, also national certification requirements, and in many cases our larger customers have their own certification requirements on top of that as well. So there are barriers to entry to designing and selling products into the markets that we serve. And finally, to say that, you know, a first-class service level is absolutely imperative. Our customers, in part due to the certification, but also due to the criticality, they don't want just anybody working on these products. They want to have an OE manufacturer's level of service that is available at very short notice to a very high level of quality. And that's what we provide via a large number of service networks around the world. I'll leave that one there, Alex, and jump on to the next one, which really is just, I think, echoing a little bit of what I just said and reminding just how important the aftermarket is for us. Around 400 people out of our employee numbers of around 3,500 are working in Rotork Site Services. We've got 50 service centres globally, and we've added a couple in the last few years. Accounts for around 20% of group revenues. We think there's lots and lots of opportunities available to this business in terms of taking advantage of the installed base, providing very specific client programs for their installed base they've got out there, things like our lifetime management programs, etc. as well. From an investment perspective, what's attractive about our aftermarket business is that not only is it 20% of group revenue, so a material part of the whole, we're also growing faster. Site services growing faster than the growth overall has done for a number of years, and it's accretive to the group margin as well. So it's a very attractive part of Rotork, and one where we're very, very keen to continue to grow and to invest, etc. If you want us to jump onto the next slide, Alex, and I might check it back to Kiet.
Yeah, okay, thank you very much. So what I'd like to do now is to take you through Rotork's investment case. So to start, I'd like to explain how Rotork creates value for all of our stakeholders. So, you know, customers are at the heart of everything we do, and it's by identifying their flow control challenges and solving their problems is what really makes Rotork a trusted partner. So helping our customers improve their safety, reliability, efficiency is key. To deliver that, it's innovation. So we pride ourselves in delivering great products and innovative solutions for our customers. And really, Rotork is seen as the #1 electric actuator company in our industry, with good differentiation between us and our competition, and that's what stands us apart. We're also committed to enabling a sustainable future. You know, having electric actuation leading in that class has really given us the technologies to take advantage of new energy and technology markets that will help deliver a decarbonised economy, as well as a greater energy security. And we do all that by providing a safe and diverse and inclusive environment for our people, celebrating diversity and inclusivity throughout our organisation. And then lastly, our strong balance sheets enable us to fund organic and inorganic investments that we need to deliver and drive the growth for Rotork. So that's how we create value for our stakeholders. If we move on to the next one. These highlight really what our key growth drivers are in delivering growth for Rotork. So firstly, as I mentioned earlier on, we realigned our organisation in 2019. We completed it in 2020 to focus our business on 3 key end markets, which is oil and gas, chemical process and industrial, and then also water and power. That's really helped us and allowed us to increase the customer intimacy with these customers, focusing on these dedicated markets. Andrew mentioned our site services in the previous slide. That's a key differentiator for us, as we have really fantastic coverage of service networks across the world to deliver aftermarket services. And we have key initiatives such as lifetime management, including intelligent asset management programs, which are really helping our customers understand their processes in more detail. The third element is high growth regions. So we are focusing our strategy on high growth regions, which means investing our resources in areas that are growing faster than the other parts of the markets. And then fourthly is innovation and NPD. As I said, Rotork is seen as the #1 electric actuator company. We pride ourselves on delivering great solutions, great innovations, and we want to be able to maintain our differentiation and competitive gap between us and our competition. So focusing on innovation and new product development is key to delivering that. And then lastly, with the global megatrends of automation, electrification, and digitalization, there are a number of new adjacent markets, which I can talk a bit more in detail a bit later on, which really are falling into Rotork's strengths. New markets such as methane reduction, hydrogen, biofuels, waste to energies. These are high electric actuator and actuator intensive markets. And actually, it's an area where Rotork is very strong. And this is an area where we'll look to grow our business. Then to underpin all of that, for us at Rotork, it's by being easier to do business with. It's really, again, what sets us apart and what we'll continue to do as we go forward for our customers. So if you move on to the next slide. So this slide shows the revenue history of Rotork over the last 10 years. And so you can see between 2011 and 2014, our sales grew really, and we benefited from the oil and gas super cycle throughout those years. However, we unfortunately were not immune to the 2015 great oil bust, hence the decline in revenue in 2015. Subsequently, we grew our business back, growing in other areas outside of oil and gas. But again, with the slowdown in 2019 in the oil and gas market, and then the onset of COVID, with the follow-on supply chain and logistics disruptions, our sales, together with many other companies, has declined. However, if we look at our future strategy, we think we're really well positioned to grow. And again, I'll talk about that in a couple of slides' time. But in summary, looking at the macro trends, and especially looking at the energy security fears, and with Europe trying to become independent and wean itself off the Russia oil and gas, we anticipate an uptick in the oil and gas cycle. Which therefore means that we're extremely well positioned to profit and grow from the oil and gas uptick. There's also accelerated spend in alternative energies, as I just mentioned, in the adjacent markets. And again, we're very well positioned to grow in that area. So we feel good about our future going forward, but I thought it would be good to show you a history of where we've come from. Do you want to move forward to the next slide? So this shows you what was happening with operating profits in the same time period. I think what's right to say is that Rotork has had a great track record in delivering high margin returns. And you can see that despite the sales declines, we've never dropped below the 20% mark. Our ambition is to deliver mid 20s adjusted operating margins over time. Over the last 4 years, we've introduced initiatives to really improve our operating margins, which has had a lot of success. Those have driven initiatives in terms of continuous improvement, productivity improvements, and also site consolidations, which has helped driving our profit margins. The dip in 2021 came from COVID and the ensuing supply chain difficulties, more specifically the shortages in chipsets and electronics, and therefore the huge increase that we've had to pay in terms of those electronic components. You know, components that we were used to paying maybe £1.50 for, we ended up paying about 50, 60, 70 pounds for, which by and large we have been able to pass on those costs. But those shortages have meant that our revenues have decreased. So we moved on to the next slide. I'll just take a pause there and I'll hand over to Andrew to talk to you about our sustainability.
Yeah, no, absolutely. I mean, clearly sustainability is something that's increasingly important for our investors. I think it's important to say up front that I think sustainability and the environment has always been very, very important for Rotork. It's not something that's particularly new to us. However, I guess the reporting on it and the external interest has clearly gone up more than a notch over the last couple of years. What we wanted to highlight on this slide was a lot of the work that we were doing in 2021, and that was basically coming out with our net zero targets, which I say we announced them in March 2022. So this was a really big project with a lot of work from a lot of people in the organisation for pretty much throughout the whole of 2021. And I won't necessarily run through everything on this slide, but I think the key things here are we've announced our targets, we've submitted our commitments to the Science Based Targets Initiative. We're looking to reduce our greenhouse gas emissions to net zero for scopes 1 and 2 by 2035. So pretty ambitious. We're looking to, on a scope 3 basis, to be able to achieve that by 2045. We've done a lot of work on the main categories of those scope 3s. They really come from the energy used by our products during operation. So we're obviously going to be working quite hard very hard over the next 10, 15 years to reduce the energy used by our products from already quite low levels, actually. And we're also going to be working hard with our suppliers, reducing upstream emissions. We've got science-based targets, which are most interim targets, which are listed there on the right as well. I think what's important to note, and I guess that I haven't put on this slide, it's to say that we've done a lot of work on this. We have identified how we are going to achieve these targets, and we've identified that the cost to achieve them isn't going to be any greater than kind of business as usual. There are some companies out there who are working very, very hard on a similar method, but there are parts of their operations where they don't know how they're going to get there, and there can be in some cases quite significant either capital or operating costs to be able to achieve net zero. In Rotork's case, we consider it to be we know how we're going to achieve these kind of things, and we've got a pretty good idea as to how much it's going to cost, and it shouldn't be any more than business as usual, which I think is important. Alex, if you just jump onto the next one. I think we've got a second slide just talking about sustainability. Yeah. So this slide is trying to answer a question that we regularly get asked, which is what proportion of our sales are of products and services which have particular environmental or sustainability benefits, or which enable the energy transition, decarbonisation, etc. And we spent a lot of time again last year in 2021 identifying those products and services that satisfied that question. And we introduced our Ecotransition portfolio, which we summarise here on this slide, again in March of this year. I think the first thing to say is it's difficult for us to quantify this precisely. And the reason is that in some cases, our products are being used by a customer in a way that we're not fully aware as exactly what they're being used for. So actually quantifying it accurately is difficult. But what we can say is the 3 portfolios on this slide that are only part of our eco-transition portfolio contributed around 30% of sales in 2021. So for us, our eco-transition portfolio is bigger than 30% of sales, potentially significantly more so. And again, I won't necessarily run through every bullet point here, but you can see the themes in the portfolio. So we consider all of our products that are being used in water and wastewater and desalination to be part of the eco-transition portfolio. We've got a portfolio of products that are increasingly being used to reduce methane emissions. So we include our electric actuators that are being used in non-traditional applications in the oil and gas upstream and also in pipelines. And then it also captures these quite, slightly smaller at the moment in terms of proportion of the portfolio, but the new energies and the new technologies that are very definitely coming through now quite strongly. So you'll be hearing about projects that are going on in things like carbon capture, usage and storage, also hydrogen. We put in there LNG as well. We see LNG as being an important bridge fuel to a decarbonised future. And LNG is an important segment for Rotork. Tends to be a little bit more cyclical than some of the other segments, but we were very, very active in LNG through the periods of 2014 to 2016, and that cycle now seems to be upon us again. So we're anticipating LNG being bigger as we go through the next several years. I think that's all I'd like to say on that slide. So if you wanted to jump on one, Alex. Yeah,
right.
Back to you, Gick.
Yeah. So, I mean, we talked about giving you a glimpse of Rotork over the last 10 years. What I'd like to do now is talk about what I'm going to be doing with the management team over the next 5 to grow this business. So, having been in charge now as CEO for the last 6 months, I spent a lot of time in the last 6 months working with the senior team, the management team, reviewing the group's current shape and formulating the next phase of our strategy. Key to that thinking was looking at the global megatrends and identifying the trends that would deliver opportunities, but also that would bring risks. And really the future strategy is built to deliver on the opportunities, but also to overcome the risks. So the first part, or the first pillar of the strategy that you see here, is identifying targeted segments where we have the right to play and that we believe will offer significant opportunities for profitable growth. So within these targeted markets, they will include elements such as subsegments such as methane reduction, LNG, as Andrew talked about, mining, semicon, HVAC. So these are the key markets where we've looked at and we think are still growing, and the trends will still grow and deliver growth over the next 5 to 10 years. And they're the markets where we really want to focus on and concentrate to deliver our growth. So in terms of those mega trends, we see a world where developing markets grow faster than the developed world, where automation, energy efficiency, electrification drive premium growth rates, as do digitalization and industrial internet. We see a world where infrastructure modernization and investment grows faster than GDP. For example, that infrastructure investment is very prevalent in the water industry to overcome water scarcity trends, as well as provide energy security trends. And then finally, we see a world where climate change is at the fore, meaning growth opportunities in energy transition. So that includes the emissions reduction, as we talked about, new energies such as green hydrogen, and then transition fuels such as LNG, as Andrew mentioned. But it also brings opportunities in water management. With water scarcity, there's desalination, which is the production of water from seawater. recycling of wastewater, and also flood defence. So these are large markets which we think will grow over the next 5 years to 10 years, which will really focus and grow. The second pillar is about value, adding customer value. So I said earlier on, in terms of creating value for our stakeholders, well, I want to put the value that we give to our customers front and center in terms of everything we do. So every employee in Rotork has their part to play in delivering the value to the customer. That's what drives our differentiation. That's what drives the repeat business and the brand reputation that Rotork has. In addition, we'll also drive some specific initiatives to maximize this value. And the first one, the go-to-market enhancement, that's about building on what we've already done in terms of our end market realignment. And it's building on our relationship with our customers and building on our key account management programs so that we can grow in the targeted segments that we have identified. Then the global supply chain program, that's about overcoming the risks of what we've seen. So those programs will improve our transportation networks, help us reduce our lead times, look at our inventory in the right ways where we can reduce our product lead times to our customers, thus being more easy to do business with. So we already have market-leading products, and what I want to drive is market-leading customer service, hence the improved customer experience. And then lastly, in this pillar, we really want to leverage our services networks across the world to be able to perform more aftermarket services and provide more intelligent services to our customers. Then the last pillar is innovative products and services. As I've said, Rotork has a reputation of supplying the best electric actuation in the market. So innovation is really the lifeblood of Rotork. So going forwards, our future innovations will be aligned to our targeted segments. And the key drivers for innovation will be around electrification, connectivity, predictive analytics, and product efficiency. All of those elements help drive us deliver a sustainable future, but also help our customers reduce their emissions and their energy usage. We'll also look at make versus buy. So where it's right, we'll design ourselves, and where we'll need quick access to technology, or where we want to go into new markets, we'll also look at acquisitions. So this is really our strategy in a nutshell. But to summarize, with the strategic work that we've already completed, looking at the macro environment and the trends such as energy transition and energy security, we're confident that we're well positioned to deliver on our growth ambitions going forwards. So if you can move forward to the next slide. So that's a summary of our strategy. What I wanted to do now is just to quickly cover the H1 trading for Rotork. And this is a slide out of our mid-year interims. And as you can see here, in the first half of this year, we actually saw good momentum that we saw in Q4 of last year continue through. So orders were encouragingly 12% up year on year on a constant currency basis, with all three divisions having increased bookings. So CPI and oil and gas led the way and saw particularly strong growth in the first half of this year. Therefore, we firmly believe that our strategy in focusing our sales teams on specific end markets and segments within those end markets, investing in key geographies and in our aftermarket activities is really delivering results. However, due to the supply chain disruptions, we see that revenue is behind approximately 5% year on year. So that's a revenue translation from our order input due to the supply chain difficulties that we've had, and more specifically due to us being starved of electronic components to be able to build the products that is in our order book. However, with sales down, we're still delivering strong margins in H1, and we're still delivering strong return on capital employed, which shows really the strength of the business. So we move on to the last slide. So in summary for Rotork, we are a first-class engineering company. We're a purpose-driven company, which is to keep the world flowing for future generations, creating value for all our stakeholders, and we're committed in delivering a sustainable future. Our financial ambitions are to deliver mid to high single-digit revenue growth and mid-20s adjusted operating margins over time. And then looking at the H1 trading, we've had encouraging order intake in the first half of this year. H1 sales and profit has been lower due to the supply chain issues. However, we go into the second half of this year with encouraging momentum, and our outlook is confirmed. We have a really good visibility of our order book going into H2 as well. However, we still anticipate that H2 will have a greater than usual weighting than in previous years. So that really wraps up this presentation and summarizes Rotork. I think at this stage, we'll open the floor to questions.
So Gig and Andrew, thank you very much for that presentation. We are now going to go on to questions. There's a Q&A box at the bottom of your screen, so please, if you could type any questions into that. I see a couple have come in. We've also had a couple that come in ahead of time. So I'm going to start with a question that came in ahead of time here, and I'll then go on to some of the questions that have come in during this presentation. And the first question is, it's good to see that order intake is up 14% in half one. The company does state, however, that price increases were implemented in January and May. Therefore, could you please elaborate further from a unit perspective? Are unit sales up, flat or down in the same period?
Yeah, okay. Let me kind of answer that by splitting input and revenue. So, but also giving you some background. So last year, we also put through 3 price rises. And so within our order book, in terms of at the end of H1, it's quite hard due to mix, but we think our input in terms of pricing is high single digit. So therefore the rest you can consider as volume increase, okay? Again, mix does muddy it. So pricing in our input, high single digit, then the rest we would consider as volume. However, in the output, because of the supply chain disruptions, we haven't been able to translate our input into output as what we would normally do within the year. So we have got a record order book, a record backlog, and therefore that's why sales are down. So within the sales element, we think that pricing is around mid-single digit effect. So therefore the decrease is a volume decrease. But that is a direct correlation to us not being able to supply product out the door due to supply chain disruptions, rather than having the orders to fulfill that. We absolutely have the orders to fulfill that.
Okay, thank you. Got a couple of questions that come in on the dollar. One was, how does the weak sterling benefit you? And the other is, how does a strong dollar impact your business?
Do you want to take that one then?
Yeah, in the absence of our finance director, I'll throw that one, I guess. I think, what's the best way to think about this? I think I said when I talked earlier on, do be very aware that we are a very global business. I think that's the first thing really to say. Yeah, we have people all around the world, and we have facilities all the way around the world. So, whilst we do have a significant number of people in the UK, and we have got a handful of factories here in the UK, including a reasonably large one, our Bath facility, which is just a few hundred yards away from this office that way. I think overall, Remember, we're a very global business. We will obviously see some translation. If sterling remains weak and dollar remains strong, we would obviously see some translation benefits of that. I think transaction is going to be relatively minor.
Okay, thank you. Coming back to the supply chain here, you said that sales were impacted by problems in the supply chain. Can you give an indication of the magnitude of that impact? And are you still seeing problems in the supply chain?
Yeah, I mean, I can't give absolute numbers, but normally our book to bill ratio is nearer the 1. Okay, so whatever we come in, whatever we have in with input, we pretty much get out in output within the year, roughly.
Yeah, so around 1 and a bit for the full year,
Yeah.
but it's probably 106, 107 in the first half.
Yeah,
something like that.
Yeah, which means that we haven't been able to deliver what we would normally deliver, so it has had an impact. Specifically, where we're suffering is in our electronic actuators. We are struggling to source electronic chipsets. With being the #1 electric actuator, and our actuator is absolutely robust. I mean, it's bomb-proof. If you want to buy an actuator and have peace of mind, it will not fail, you will buy a Rotork. In delivering that type of quality and robustness, the chips and the components we're using are the high-end ones. They're the ones actually where the semiconductor manufacturers are pausing or putting on long lead times as they concentrate on lower and higher volume electronics for the software industry, for your phones, your laptops. So what we're seeing is the components that we're needing have got really long extended lead times, or actually in some cases they're being made obsolete. So that's why at first we struggled to get these electronic components in. Second to that, therefore, whatever was available in the market, the demand was a lot higher, so the pricing of these components went up. When we saw this, and we saw this towards the middle of last year, we really put in proactive mitigation actions to overcome these issues. So the first thing we did was we changed the way we buy our electronic chips. Normally we buy our boards already made from a supplier which buys the chips themselves. We actually hired in chip experts in Asia, and we actually source those chips directly ourselves now, and then we free issue to our suppliers. That meant that we had a more direct control over our electronic chip supply base. So that was the first thing we did. We then brought forward as much as we could when we saw there was supply. So at the back end of last year, we bought for some chips all of the components that we needed for this year. But because of the sheer amount of electronic components that we use in our components, it's unfortunate we can't predict every single shortage. So we're still having these issues, and it becomes a bit of a whack-a-mole where you solve this one and then this one pops up. So we buy forward as much as we can where we see issues. And then the third point is where we saw chips go obsolete, what we did was we put in engineering programs. And to date this year, we've completed 29 re-engineering programs to use different types of chips which were available. All of those things took time to embed and come through. And what we're seeing actually in the second part of H1, those actions were taking hold, and we saw encouraging momentum in terms of our delivery in May and June. So we're confident that the actions that we've been put in place are taking hold and are taking effect. That's probably the predominant reason why we're seeing that momentum. However, in the market, we are seeing a stabilization of the issues. So they're not getting worse, and if they're probably slightly getting better, but nothing drastically. So that's the current situation. So there was a lot of self-help there in terms of overcoming, but we are seeing a slight improvement in terms of things aren't getting any worse and they're getting slightly better.
Yeah.
Okay.
And maybe, Alex, just with the book to build point that we were making, I think what we're trying to say is if we'd had a year, a first half, I should say, like previous first halves, that book to bill would probably suggest that revenue would have been probably in the region of around 320 million. So if we use the orders as being a sort of in a normal time where the supply chain means we can get stuff out the door, that's kind of where we'd have thought our revenue would be. The number itself was 280 million. So there is a big difference. That difference of sort of 40 million or so obviously sits in the order backlog as we go into the second half. And if we see that, I guess, stabilization of the component availability and the logistics and our self-help measures doing better, we would anticipate seeing some reduction in that order book as we go through the second half. And that's why the analysts and I guess ourselves, we are thinking that it'll be an unusually big second half for Rotork this year.
Brilliant. That's very helpful. Thanks for clarifying that. You elicited a slight follow-up question on the chips here, Gig, which is, can you ensure that the chipboards developed from the subcomponents are qualified?
Yeah, absolutely. I mean, everything we do has to be recertified. So it isn't just changing the chips, hence the time. It is changing the chips, re-engineering the circuit boards, and then putting them back through recertification of recertification bodies, because what we do is supply into the explosion-proof environment. So it's very stringent. So every chip design we make gets recertified externally by an external board and recertified.
Okay, thank you. Question here, margins fell in the first half of the year. Is that just due to the impact of lower sales, or are you finding it more difficult to pass through cost increases?
Yeah, it is. It is absolutely down to the volumes. In one of the slides, in the profit slide, we run a capex light model. So although we are a global manufacturing company and we have manufacturing sites across the world, we actually have an assembly model. So there's no heavy engineering. We're not vertically integrated. We typically buy our components and assemble. So it's a very asset light model. And therefore, volume has a large impact on that. So if we get good volumes, we get good drop through on those volumes. But when the volumes aren't there, we do suffer from the profits. If I link back, the volume is there in our order book. So it's about translating that order book into delivery and overcoming the supply chain issues. In terms of pricing, we have been able to, we put through 3 pricing increases last year, which has stuck. We've put through 2 pricing increases already this year, which have also stuck, and you can see that in the order book. So actually, in terms of our product positioning and being able to pass through price, we're very confident that we can, and that's the case.
Okay, and then a slight sort of follow-up or link question. If order books are at record levels, but you're experiencing cost inflation, when you come to deliver those orders, are you going to be squeezed on the margin?
No, because those orders taking through, let's say, have been priced at the level. So the price increases that we've done, they have taken into account the cost increases that we anticipate to experience throughout the year. So they're not backwards looking, they're forwards looking as well. And as we sell our products, we price that product to suit. So typically we will cover the cost. Now, there are instances where we have very long projects in terms of over a year, and our component costs could rise. In those cases, in some cases, we have price escalation clauses, and in other cases, we do look to go back to potentially readjust prices. Okay,
thank you. A question here on ROCE. What ROCE do you want to see from your acquisitions, and how will that affect your regular ROCE, and how do you treat goodwill as part of your capital?
Yeah, I think the ROCE question is a tough one to answer in in its isolation. So the acquisitions we do will be built around a full package of, is it the right fit for the company strategically, and does it fit financially? The ROCE will fall part of the financial measure, but in terms of our financial measure, it's returning WACC within 3 years, let's say, is the overall financial measure for us. I think ROCE will reduce initially once we acquire, but we look to then deliver back and bring back to normal levels.
Okay.
I think it's worth that, the financial characteristics of what we're looking for, it is definitely, ROCE returns greater than weighted average cost of capital in year 3, and we want to be very, very disciplined. We don't want to overpay for assets.
Okay, thank you. Next question: what is the spend on R&D?
So last year was approximately 2.5% as a percentage of revenue. We think that is the right amount. As we grow and as we become successful, I would look to increase that, but only when we become successful. I'm not looking to increase R&D spend at the cost of returns or margins, so it will be self-funding.
And I think it is worth just mentioning, we have this debate occasionally with investors. Our R&D spend, it's quite pure, it's quite innovation driven, it's research more than it is product development. There are a lot of application engineers within Rotork who are basically working on existing products and tuning them for particular applications, various things like that. That expense would not be included in our definition of R&D. So whilst the 2.5% of sales might seem like a slightly lower number, we haven't gone out of our way to necessarily make it sound like a big number, if that makes sense.
Yeah, very clear. Thank you. Next question here: what percentage of sales do you expect from adjacencies over the next 5 to 7 years?
Again, I'm not going to put an absolute number on that, but we expect that the rate of growth of our business coming from adjacencies will be higher than the rate of growth of our current base business. That is an area where we will look to invest, commit resources, and look to grow faster than the rest of the business.
I don't think we're trying to be evasive in any way with that at all. So we're holding a capital markets day in early November, which I hope people will get the opportunity to either listen into or get some of the feedback from afterwards. We are working with external management consultancies on questions a little bit like that, and in many cases it's impossible really to be very specific. How big will the hydrogen market be? How big will the carbon capture market be? No one knows. We think that all the signs are that these are going to be good sized markets that will be very material for us, but genuinely, who knows? And people who are paid to put numbers on these aren't prepared to. I mean, we've gone out to a number of consulting companies who have actually come back to us and said, look, we can't do this. The market, we can't put an absolute number on the market at the minute.
Okay, thank you. The oil and gas market seems to be pretty buoyant at the moment. And question here is wondering why your sales to this market actually fell during the period.
So, and again, that's linked to the input and output. So if you look at the input, which is the orders coming in, they absolutely grew. So oil and gas input in the first half grew, double digit. So it was a good percentage. But what you're seeing is the translation into revenue not taking place due to the supply chain disruptions, but the actual growth within our order book is there, mirroring the growth of the oil and gas market.
Okay. Next question here. Can you say more about the scale of the opportunity in predictive analytics, and do you need to get more involved in software?
Yeah. So again, that links back to what Andrew was saying. It's quite difficult at the moment to put a number on growth in terms of predictive analytics, because each customer themselves are going through that journey. And again, it's quite difficult. There's no market data out there to say, you know, how many companies are going in that direction. However, what we will say is it will form a key part of our strategy going forwards. You know, we're working with a number of companies at the moment to provide that predictive analytics capability. I think where we are at the moment is that we're further ahead than some of our customers are, so we're ready whenever they are. But that one's a hard one to put a number, just simply because the market data isn't there at the minute.
Okay, thank you. I think we've got time for another couple of questions, so let me ask you this one. Are the current concerns around the global recession likely to impact potential future capex plans at your chemical and oil and gas industry customers over the next couple of years?
It's a good question, and you know, you can read different reports saying, but for us, where we're seeing it is there's a little bit of a different situation going on, because yep, you're right with the slowing recession, but also there are energy security fears at the same time. So with, you know, gas prices going through the roof, with oil prices high, and that's all because of really demand with choked supply, we expect still the spend in capex to come through within oil and gas and within the chemical departments. With the work that we've done, you know, if you look at the price of oil at the minute, which is roughly $100 a barrel, normally break-even prices for oil and gas customers is around the $65 a barrel mark. So anything above $65 a barrel, they will make money on. The way that the oil industry is working at the minute is they're getting the extra supply from going back, not doing the big greenfield exploration type searches, or they're going back onshore or going back offshore to their existing setups and getting more supply out of those. That's actually taken their break-even points down to around $50 a barrel. So actually the price of oil is still way above the break-even point for these oil and gas customers to commit. So we actually see a continued demand and an uptick still.
Mm. And maybe to add, I mean, just as we were working very hard in 2021, thinking about net zero and what that means for scope 1 and scope 2 emissions and things, many of the kind of customers that you've just referred to have been doing very similar exercises, and they'll have made commitments to reduce their scope 1s and scope 2s. You know, we have a play there. You know, we talked about methane emissions, we talked about product quality, we talked about efficiency and automation and all those kind of things. It can be that capacity expansion plans may be slowed a little bit or what have you, but that expenditure on other items that help with the reducing scope 1 and scope 2 will likely continue, and that can be good for a company like Rotork. I think one of the ones you mentioned in there as well was also the chemical industry, and I guess one of the things that Rotork has seen for many years is the refining industry moving sort of from the west to the east. In a way, we're seeing that a bit now, aren't we, with the chemical industry as well? And you're actually seeing some of the major oil and gas companies in the east becoming more vertically integrated into chemicals and things. And so you're getting a movement of where the manufacturing is happening as well. And that can be quite good for us as well, given we've got a very, very strong market position in Asia. So, you know, I guess we're very aware and we're watching what's going on in terms of the economy, and we are very aware the market is very concerned that there's a recession coming, but there are other things that we can play and areas that we can target as well.
Brilliant, thank you. And I've got one last question here. I know you commented during the presentation about the strength of your balance sheet, and the question is, what's the plan for the cash on the balance sheet?
Yeah, so in terms of our strategy for the cash, obviously, first is the investment back into the company to deliver our organic growth. Then, you know, progressive dividend returns. then funding for M&A, and then potentially share buybacks lastly. So that's our kind of philosophy in terms of how we manage the cash. Can't specifically say exactly now, but you can see within our strategy there's huge opportunities for growth, and really we want to be able to fund that growth.
Brilliant. Well, Gig and Andrew, thank you very much for that presentation. Really good to hear your, I guess, encouraging comments about the future despite some tough market conditions, and hear that you're still performing well. We are now going to, as I said, draw this presentation to a conclusion. As people exit, you will come to a short survey. It'd be really appreciated if you could just spend a couple of moments completing those questions. I know management find that feedback quite helpful. And there's just for me to flag up our next webinar, which will be on the 20th of September with Capita. So again, thank you very much for coming, and we hope to see you all again soon. And again, a final thank you to Gig and Andrew.
Thank you, everyone.
Thank you and goodbye.